new asset like furniture, pictures, equipment, land, buildings, right? So you can have a physical substance of those assets that you see. You can touch, you feel it, you use it, right? So that's one part of asset. The other part is intangible, right? Intangible means those assets confer certain rights on the corporation, right? So by virtue of legality, right? So for example, patent, trademark, right? Franchise, license, right? So these are the rights specifically conferred on the company. They use certain technology, certain type of product. They operate in a certain location. They can use some kind of space, right? So, and some kind of business model. You can think about franchise, right? On the left side of the audit building, we see a Harvey, right? Harvey over there, it's a sandwich. I sometimes eat there. Probably you already did. So these are franchises, okay? Steel bottom, that's another franchise, for example. And the company has to pay for the franchise, to purchase franchise, and then they pay on a regular basis, periodically some franchise fee. So when they pay for franchise, that's the kind of amount that is recorded in the franchise account, right? So that's an asset. And then they estimate that how much benefit that the company is going to derive. For example, franchising is for 5 years, so it's a life is 5 years for that asset. Then whatever money they spend to acquire the franchise will have to be accounted for over 5 years. We call it amortization process, right? So when we talk about asset, there are 3-4 things that we need to understand carefully, okay? And third category is the natural resources, okay? Oil, coal, right? Copper. So a mining industry. So those reserves are depleted over time when they lift the reserves, right? Beneath the earth. So they lift the reserves. So that's kind of depletion cost that we talk about in the natural resource industry. So anyway, so what is the general rule when we record? You know that the asset is recorded when assets are acquired, at least acquisition cost plus any other costs. These are all incidental expenses necessary to make the asset ready for its intended use. For example, if a company acquires an equipment, you have one example in your book, Cedar Fair. It's an amusement park. They bought a roller coaster. That's a very important asset for an amusement park. No roller coaster, no kids, no amusement park, right? So that's a major attraction, roller coaster. Okay. I don't want to go to the roller coaster, then I will have a heart attack. So the kids are like you people, you like roller coaster, you go there, you run at 60 miles or 70 miles an hour, my goodness. So that's the kind of things. So they acquire roller coaster, and then there's an installation cost. So all those incidental expenses together recorded in the asset account. Okay. So here there is an example. For example, if the company purchases a land, the purchase cost definitely will be there. Then other legal fees, the registration charges, title search fee, all these are taken together and recorded in the land account. Okay. And as you know, land is the only asset which doesn't depreciate, right? So land, you will not see any depreciation expense associated with land, right? Land essentially is supposed to increase in value all the time, most cases, right? So we keep it that way, record the land cost in the land account, okay, and that's it. But regarding buildings, for example, purchase cost or construction cost, if the company constructs a building, then legal fees, appraisal fees, or architecture, all other associated costs, okay, are included in there. Equipment, purchase or construction cost, any sales tax, any transportation cost, right? Bringing the equipment from the manufacturer's space to the company's space, right? And any other installation charges, any transit insurance cost, okay? So if you carry a heavy equipment by road or by rail, whatever, you have to buy insurance, right? That's an accidental insurance. The premium for that will form a part of equipment cost, things like that. Even when the company purchases an equipment and want to house it in the factory floor, and for this, the company would have to remove a wall, for example, in order to install the equipment properly, then the cost of removing that wall is a part of the equipment cost. Okay? So any type of cost which is necessary to make that equipment ready for its operating condition. Okay? Plus the acquisition cost, everything. Alright, so this is the basic principle. So this is called the historical cost principle that essentially underlie this kind of accounting process. Okay, you understand? Okay? So here set up here, this is the one example, very simple example, right? So you understand that. So they purchased a roller coaster spending $25 million after considering discount. And then they spent another two. One is they paid $125,000 to have this equipment delivered and $625,000 to have it installed, assembled and installed. So it's not delivered just like a roller coaster, so it's various bits and pieces. So then they have to assemble all these things. This is an expert work, right? So it's a specialized job. So they have to spend a considerable amount of money, $625,000. So these two, 125 and 625, they paid cash, but the $25 million they bought on credit, right? So they will pay later. So as you see, this equipment is acquired, so it's a total comes to 25,750. 25,750,000. That's the product cost of the equipment, acquisition price plus transit cost and installation cost together, out of which 25 million essentially is a part of credit, right? Notes payable. So it's a longer term credit. By looking at the expense, you can see that it's a long-term credit. So it's a long-term liability that we are showing. And then the transit and the installation will be paid by cash. So that's the kind of accounting entry. So what is the main asset account? Main asset account in their book is rights and equipment, but you know, considering the nature of business as I said before, the asset or liability account, the name helps. Okay? For example, rights and equipment, you will not see that kind of rights and equipment asset name in a pharmaceutical company. For example, if I talk about, say, Mark Pharmaceuticals or Pfizer, right? You will not see rights and equipment account in their balance sheet. Okay, so that's a industry specific, business specific asset account. But the major founding principle when you talk about accounting is the same, right? It's the same. Only the name will be different based on the, or relying on what would be the nature of the business. So once the asset is acquired and installed, then in the post-acquisition period, over the life of the asset, some expenditures are incurred, right? Quite obvious. Some of the expenditures are incurred for the regular maintenance of the asset, right? To keep the asset in its normal operating condition. These are regular repair and maintenance costs, so you have to consider that as a regular business expense. It's a part of operating cost. It appears in the income statement and maintenance then for a particular year. However, there are certain other costs which are incurred to increase the service potential of the asset. Okay, so these are called major repairs or renovation or overhaul. Okay, that has the potential to increase the usefulness of the asset in terms of quality of products or in terms of extending the asset's useful life. Okay, these are called the major repairs. For example, the company has a building, right? The company engaged in the extension of one part of the building. That's an addition to the building account, right? So, and then they figure out what would be the estimated useful life, things like that. So, but that major cost is recorded in the building account. We call it capitalization of cost. That's the technical term. The costs are capitalized to the asset account. So, if that cost increases the economic usefulness of the asset in terms of increasing its efficiency in delivering product or in generating products or increasing the quality of product or extending the life of the asset, okay, or both, we record that expenditure in the asset account. We call it the capitalization of cost in the asset account, right? Enhancing its efficiency, capacity, or its lifespan, right? So this is a clear demarcation between the two. One is called regular expenditure or regular repairs and maintenance. We incur it, we record it in the regular maintenance account, and that's the expense in the income statement. And the other part is the capital expenditure, right? And we have to see. And there will be a description for it, that this is the capital expenditure, so. Then comes the question of how to account for the cost of using long-term asset to expense over the assets used. So one part is acquisition of asset, then over the post-acquisition period, over the life of the asset, what kind of expenditure we consider as a regular maintenance cost, and what kind of expenditure we consider as increasing the usefulness of the asset, of the economic usefulness of the asset in terms of quality, quantity, or in terms of extending the lifespan of the asset. And then we talk about how to account for the cost of using the asset itself over its life, right? That's called depreciation. You understand? So there are three different things here. And then we have two more things to come. So when we talk about depreciation, there are many different types of policy that the company may adopt, depending on the nature of the asset, its usage in the business, okay? Some assets are subject to rapid usage, okay, in the initial years of asset's life, compared with the later part of asset's life, right? In some cases, the asset's usage is based on certain other attributes. For example, how many units will be produced by using an asset? How many hours will be used up for this asset over its life? So that's the kind of usage that is used to calculate the depreciation based on how the assets are being used. Because if the asset is being used unevenly over time, unevenly. In some years it's subject to heavy usage, in some years it's subject to less use or things like that. So that's the kind of depreciation that's available. Yeah, right.
I just want to ask a question. When you say that there is not much depreciation when it comes to land, if the prices of land goes with the time, goes up with the time. So if we use the land with the purpose that we are producing something on the land, so are we going to take the depreciation cost that it's like we are using the land for the purpose of producing something,
No.
and its prices are going down?
No. Land is used as company usually acquires land to construct a building, right? So the building is subject to depreciation, not land. Okay. So if the land is held for sale, for example, then that land is not recorded under property, plant and equipment or fixed asset. It's considered as a long-term investment. This is another point that I would like to make because this is not discussed in the book. That how to account for an asset depends on the purpose, company's purpose of using that asset for its business operation. Some assets, for example, are held with the objective of reselling the asset in future. Okay? Alright, so those type of assets are not subject to any depreciation. Those type of assets are kept in the business account, in an asset account under long-term investment. Only those assets which are used for the regular operations of the business are classified under property, plant and equipment. Okay? Now, General Motors, for example, and say a company in Windsor, they bought some 3-4 vehicles from General Motors, and those vehicles are a part of property, plant and equipment because those vehicles are used in the regular operations of the business in Windsor. But for General Motors, those vehicles are commodity. Okay? These are not regular long-term assets for General Motors because these are the products General Motors or Ford or Chrysler or Toyota or Honda, you name it. So in some cases, some of the items which are commodities, and for that matter, a part of inventory of some companies are the long-term asset of other companies. Okay, so that's the difference. So it all depends on what's the objective of using that particular item. Okay. You talk about land. I'm thinking about a realtor or a real estate company. They are holding land with the objective of selling it. So land is a part of inventory. Okay, it's not a long-term asset for that company because they are in the business of buying and selling land or building or things like that, right? So these are inventory for the real estate company. So you have to look at the nature of business operations in order to classify the asset that way, right? So the depreciation, cost of using an asset to expense, systematically accounting for the cost of using an asset to expense. So there are many different forms of depreciation. In this book, we discuss just 3 forms of depreciation, just for the starters, right? And we also use the term amortization that relates to intangible assets. So this is the convention. We use the term depreciation for tangible asset, and for amortization, the term is used for intangible assets. Okay. So here, the effects of $130 depreciation, right? So you know that it's a pretty standard entry, right? Very standard entry. Depreciation expense debit, accumulated depreciation. Explained multiple times what accumulated depreciation is, right? It's a contra asset account. It is subtracted from the original cost of the asset to report the book value, right? We call it carrying value or book value at the end of each reporting period. And the depreciation expense is a part of regular business expense, right? So we saw that throughout chapter 1 to 4. Okay. Now there are 3 things, and always remember that depreciation is basically an estimate. Okay, estimate. It's based on estimate, engineering estimate. And one thing is pretty sure, and for this we have the pretty much solid evidence, is the first one, asset cost, right? We know the cost, plus original cost, acquisition cost, plus all other expenses together, as I mentioned. And then there are 2 estimates. One is the useful life. How long the asset is expected to generate benefits to the company. How long, right? So 10 years, 15 years, 30 years. So that's an engineering estimate. And then the other is the residual value. Now, let me tell you this. When I will give you some project to see, you will notice, in most cases, corporations don't estimate any residual value. It's too problematic, you know. Because if you install an asset with a 15 years life, how do you know what would be the residual value 15 years from now, right? Residual value is the value when the asset's life is over, the company can sell the asset and realize some money. Okay, that's the residual value. How do you know after 15 years what's going to happen, right? So that's why most companies, they set residual value as 0. Okay, almost 99%, unless they're crazy enough to estimate some residual value. It doesn't make any sense, right? But when the residual value is estimated, then we have original cost, then we subtract residual value, we get some amount that's called the depreciable value. That value will be depreciated over the life of the asset. Okay? For example, if the equipment or any long-term assets value is $100,000, that's the original cost, and the depreciable and residual value is $5,000 for 20 years, right? So the $95,000 is the residual, is the depreciable value that will be depreciated over 20 years. Okay. So that's the whole idea here. Very in a simple sense of the term. All right. So now, as I mentioned, we have 3 different forms of depreciation policy that we can think of. Remember, the companies may adopt different depreciation policy for different assets. These are allowed. For some assets, the company may assume that those assets will be evenly used over its life. So they can use straight line depreciation. And let me tell you, 95% cases you will see companies adopt straight line depreciation. Okay? In real life, 95% cases. Easy to calculate. it doesn't need much time to come up with the depreciation expense. So they do that because they said that over a longer time period, it doesn't make much sense unless the asset is subject to rapid obsolescence. Okay? For example, in technology companies, you'll see that the average life of an asset is only 5 to 6 years or maximum 8 years because of the rapid technological advancement, right? So what they do is they use the accelerated form of depreciation. One of the accelerated form is the last one, declining balance method. Okay? Besides that, for a mature and stable corporations, they normally assume that the assets are subject to uniform use over the life. So they use straight line depreciation. That means each year they charge that same amount to depreciation expense for that asset over its life. Okay? And then, as I said, the units of production, when the usage varies from one period to the next, then they estimate that how many units of finished product will be produced by utilizing this asset. And based on the actual production, they calculate depreciation. So it widely varies from one period to the next if the production changes frequently from one period to the next. Okay? So very simple formula. So cost less residual value divided by useful life, you get depreciation, yearly depreciation expense, or periodic depreciation expense over the life of the asset, which is straight line depreciation. Very straightforward approach here. So as a result, depreciation expense will remain unchanged, and the book value will decline, okay, monotonically. So you have one example here. I strongly advise you to review this one on page, on page 421, 422, and 423. Very simple. Very simple level. Yeah, very simple level. So this is the way. For example, in this book, Cedar Fair Aquarium cost is 62,500 and estimated residual value is $2,500. So 62,500 minus 2,500. So the $60,000 is the depreciable value. And the estimated life is 3 years, right? It says estimated useful life 3 years or 100,000 kilometers. So we will use 100,000 kilometers if we adopt a usage-based depreciation policy. Okay? Now, if it is straight line, the matter is fairly straightforward, like $60,000. We depreciate over 3 years, so $20,000 each year. So when I charge 20,000, 30,000, so I think the depreciation balance will go up, and the book value will go down. And at the end of the 3-year life, you will see the book value is set already at residual value at 2,500, so the book value will be 2,500 at the end of the asset's life, right? Because we said that 2,500 when we calculate what would be the yearly depreciation, right? So that's we can see here. Now, if you look at the units of production method, it's a very straightforward method. So what we do is we have to see what is the depreciable value. Again, when we set the annual depreciation, what would be the depreciable value? We subtract residual value from there. In this case as well. So $60,000 and the kilometer estimated usage is 100,000 kilometers. So 60 cents per kilometer is the usage rate, right? 60 cents. Now you look at this, how they are used up. They used up 30,000 kilometers, 50,000 kilometers, and 20,000 kilometers, right? Over 3 years. So then 30,000 times 60 cents, then 50,000 times 60 cents, then, right? And then 20,000 times 60 cents. Once these are done, again, your book value will be reduced to $2,500. That is the residual value at the end of the period. Again, the same thing. only it's based on usage. Now, if I talk about declining balance, that's a little bit accelerated form of depreciation. That means the depreciation expenses are higher in the initial early years of assets life, and it's a smaller in the later part of assets life. However, the total depreciation over the assets life is same under any of these methods, right? So that's the whole thing. One important distinction between this method and the other two methods is that at the beginning of the period, we don't consider residual value for the purpose of calculating depreciation. We are considering the rate straight on to the original cost. Now, what is the rate? We call it declining balance method or double declining balance method. That means the rate, unless anything is set to the contrary, in absence of any other information to the contrary, we will assume or we will consider the rate will be double the straight line rate. Sometimes it says that the company will charge the depreciation on an accelerated basis at the rate of 150% or 170% of straight line rate. But if nothing is said, then we will consider it's like double the straight line rate, that is 200%. So here, when we talk about the depreciation, then the equipment has a life of 3 years, right? 3 years means 33 1/3%. That means the declining balance rate will be 66 2/3%. Right? 66 and 2/3% will be the declining rate. So if you apply that, then on 62,500, that is the rate applied directly. Follow this carefully. This is applied directly on the original cost without considering residual value. 62,500 apply 66 and 2/3%, or that means 2/3, right? You apply that, and you see that depreciation expense is quite large, 41,667. That is subtracted from the original cost to arrive at book value at the end of the first year, and on that book value again apply 66 2/3%. Okay. So it says that's why it's called declining balance method. So the rate is applied on declining balance of the asset. However, as I mentioned, regardless of what you do in the interim time period, your total depreciation expense over the life of the asset will be the same under any of these methods, right? So the objective is to depreciate $60,000 in total, right? So it's acquisition cost is 62,500, its residual value is 2,500, right? 60,000. That should be the total depreciation, even under declining balance method, so that at the end of the asset's useful life, the book value of the asset will be 2,500. So in the third year, we just take the difference between the book value, third year or the final year of the asset. We take the difference between the book value at the beginning of the final year and the residual value. We consider this difference as the depreciation expense of the final year. Okay, so that we can have the net balance in the asset count equal to the residual value. That's 2,500. Okay. So that's the distinction between this method from the other two methods. All right. So all these calculations have to be on page 423. Okay. Any question? This is just a calculation, okay? And I know that all of you will be able to do that very well. Because at the core of my heart, I think that you are smart people. Only thing is that you are enjoying life a little bit more without coming to the class. I'm not talking about you because you are in the class. I'm talking about your friends, those friends, okay? Now, so the other question would be how to calculate the partial year, no cell phone, okay? No cell phone. What are you looking at? No, no cell phone. Okay? Partial year depreciation, partial year. Now, you can assume that the asset is acquired at the beginning of the year, right? It can be acquired at any time during the year, right? So, how to calculate depreciation for a fraction of the year in which the asset is acquired, right? Simple. Now, this book is very restrictive in its discussion because this is basically, this book is written for a starter, okay? Just to give you some idea, that's it. Normally what happens is you take the depreciable value or depreciable cost, times the rate, whatever rate of depreciation, and then you consider how many years, how many days in a year, 365 days, and how many days that asset will be in use during that year, okay, during the year of depreciation. So that's the kind of fraction. There are many different ways this fractional period depreciation can be done. Half year convention, full year convention, last year convention, final year convention, things like that. So I don't want to discuss all these things because this is a very elementary beginners class. So just don't want to confuse you. Okay, only thing is that the partial period depreciation you can utilize number of days that an asset will be used in the first year of its acquisition by considering the number of days in a year as 365. Sometimes some people may use 360 days a year, right? Just to make it nice calculation is concerned. Okay, so that's it. So next one. Next part that I would like to talk about is if those estimates change, okay? So as we see that there are two estimates that the companies make at the outset. One is useful life and the other one is residual value, right? So if those estimates change in a particular year, the company will have to recalculate depreciation expense, okay? Some residual value may decrease or may increase based on the market condition, because it's a 10-15 years time horizon, or 5 years, 6 years time horizon. That's a longer time horizon, so that those estimates are subject to change, okay, and based on the economic situation in the market. So if we think about the residual value being higher now, or useful life will be longer than what was anticipated before, then we will have to redo the calculation. So that's the whole idea. It's a very simple thing to understand, basically. So here you have one example, okay, on page 426. So these are very simple situation, right? Assume the same company, Cedar Fair, which is an amusement park, as I said, purchased a roller coaster for $660 million, right? $60 million, with an estimated life of 20 years, right? And a residual value of $3 million. So 60 million is the original purchase cost, including all charges and everything. Total amount recorded in the asset account, $60 million, and 3 million is the residual value. So its depreciable value is 57 million, right? So it's a simple calculation, $57 million. And its estimated life is 20 years, right? 20 years. So each year, the company depreciates at the rate of 1/20th of $57 million, right? That means 2,850,000 or something like that. That's the yearly depreciation. So, and then company started charging that depreciation, no problem. Now the question is, Cedar Fair shortly after the start of year 5, so 4 years gone this way, each year $2,850,000. At the beginning of 5th year, Cedar Fair estimates that instead of 20 years now, it's the total life of the equipment will be 25 years. 25 years, right? 25 years. So what you do, and its residual value, which was estimated as $3 million, now it's $2 million or 400,000. Right? 2 million 400. So first of all, what you need to do is to look at what is the book value of the asset, right, at the end of 4th year. So you multiply 2,850,000 times 4 to get the total accumulated depreciation, right? And then you subtract from $60 million. That's the book value. From that book value, we subtract the estimated residual value because that value is expected to be at the end of 25 years. The expected residual value is now 2,400,000. Subtract that. So if you do that, then whatever be the amount, that will be depreciated over the next 21 years because 4 years gone. Now, according to the estimate, the estimated life is now another 21 years. That's it. Then from 5th year onwards, unless in future some other changes take place, the depreciation per year from 5th year onwards will be, according to the estimate, is 2 million 200,000. Right? So that's the way the change in estimate will take place. Okay? You understand? It's all about calculation. It's all about calculation. Simple calculation. Alright? You got that, right? Any question at this point? No? Okay. Now there is another term that we would like to address is impairment charge. So these are the things. We record the total acquisition cost. We figure out what would be the useful life, what would be the residual value, we calculate depreciation. If some estimates change later, we have to recalculate depreciation over the remaining life of asset, right? We have to consider what is the regular business expense, what is the regular repairs and maintenance, what is the capital expenditure or the major expenses incurred to increase the future service potential of the asset, how to account for those expenses, right? So capitalize the asset account, things like that. Then comes the question if the asset loses its value. And that essentially, in most cases, takes place when a company operates in an industry which is subject to rapid technological advances, like technology companies, right? Or sometimes pharmaceutical companies, chemical companies, biochemical companies, things like that. As a result, what happens that this is the technological economic conditions that make an asset less useful, okay, and bringing down the value of the asset below its carrying value on a permanent basis. Now think about this. An asset's value is determined by considering how much economic benefits the asset is going to generate in terms of earnings and cash flow to the company. Now, because of the technological advancement, the asset is subject to technological obsolescence. Sometimes the assets are because of the poor maintenance, okay? The subject or because of some other rapid usage, the asset may lose its usefulness. That's called the physical obsolescence. So there are two types of obsolescence in product categories that we can think of. One is technological obsolescence, the other one is physical obsolescence. That will significantly reduce the usefulness of the asset's value and making the fair value of the assets below its carrying value. On a permanent basis, there is no chance that the asset's value will increase in future. If this thing happens, then we call it impairment in the value of assets. So assets value has been impaired. So when this thing happens, then we have to consider the loss on impairment in the income statement. Okay? Loss on impairment. and reducing the value of the asset from the other side. Okay? Alright. So, here is one example. Sometimes what happens is the asset has completely defunct, has been completely defunct. So in that case, what you need to do is you have to write off the asset completely from the book. Okay, it's of no use. It's useless right now. So it's a piece of junk, right? So what you do, you have to write off the entire value of the asset from its book, from your book, and by recording an impairment loss. And in many cases, it's a pretty substantial amount. So in your book, I think they have mentioned about something. For example, here, if you look at 427, I'm saying all these things because when I give you a project, you will see all these things. Okay, I'll ask you questions. You'll have to look at all this annual report and we'll figure out where they are, and you have to mention all these things. Okay, so that's why I'm asking you, I'm telling you these things. Okay. Many years ago, one of the steel towers, this is for, I think, Cedar Pierce. Many years ago, when one of the steel towers on Cedar Pierce vertical slingshot ride mysteriously snapped during the winter, a bizarre phenomenon known as vortex shedding, the company recorded a $3 million impairment loss when it wrote down the book value of the ride. You have to write down the book value to that impaired value, okay, and take the difference as the loss. $3 million. More recently, in 2015, the company recorded $21 million of impairment losses, which included an $8.6 million impairment loss when its Shoot the Rapids log flume ride was deemed unfit for use. Okay? So, $8.6 million for a particular ride. It's an asset, right? It's an asset for this company. And they just simply write it off. So reduce the asset value and then they record the loss. So how we can do that? So this is the question, accounting point of view, how we can record the impairment loss by following certain accounting process. So what we do is this. First of all, a company, you have the value of the asset here. Okay, you have an asset, any type of long-term asset, you have accumulated depreciation, right? So you have this value, right? So you have a book value, right? Book value of asset. And then what happens is the fair value of the asset is less than the book value on a permanent basis, right? So what you need to do is you have to bring down the book value of the asset to the fair value. Bring it down, right? So in order to do so, what are you going to do? You have to, first of all, reduce the assets, original asset cost by reversing this entry. You eliminate accumulated depreciation, and to that extent you reduce the assets value. Okay, that's the first one. And then now you have a book value basically. So put me some numeric thing here. Suppose an asset value is $5 million. 1, 2, 3, okay? And its accumulated depreciation say is $2,600,000, for example. Okay? So its book value is $2,400,000. Okay? Alright, this is the situation. Now, because of this technological obsolescence or physical obsolescence, permanently the asset's value declines, and the fair value of the asset is now, say, $1,800,000, okay? Which is less than the book value of $2,400,000. Now this, the company company periodically tests for impairment, whether the asset's value has declined or not. Okay? So if the fair value is higher than the book value, there is no problem, no impairment. But if the fair value is less than the book value, then there is an impairment and we'll see this thing, right? Just reverse the accumulated depreciation. We make this asset, make this contra asset account zero by reversing this. And also we reverse the asset account of 2,600,000. Okay? So we get 2,600,000 from both sides. So now what is the asset's value right now? Asset's value is 2,400,000. Right? That's in the asset account. You understand? However, that shouldn't be the value. The value should be 1,800,000. Right? So what we do? Then we have to debit an impairment loss. Right? Impairment loss. And we credit asset account. Okay? With the difference between 2,400,000 and 1,800,000. So 600,000 is the impairment loss at this moment. Right? So the assets value will start having 1,800,000. Now if I estimate that this is the assets value now after taking impairment loss. Okay. Now if I assume the company assume the asset still has say 10 years life left. So now after impairment loss has been recorded, the asset will be depreciated at the rate of $180,000 over the next 10 years. Okay? So now the impairment loss which is recorded $600,000, this will go to the income statement, right? As a part of other operating expenses. Alright, so this is now in this example they say no, there is no value at all. It says that should the Rapids originally cost 10,600,000, the write was closed. So the entire book value is a loss. Entire book value. The asset has become good for nothing. Okay? So that's why they said that, well, 2 million is the accumulated depreciation, so they reverse. So keep the bringing down the value of the asset as 10,600,000 minus 2 million, right? So 8,600,000, and then they just simply eliminate completely the asset account. It's a little bit different from what I said. Here I keep the asset alive, okay, for next 10 years. But here they kill the asset. They said, well, take it out, throw it away. Okay? And so the entire book value is a loss. You understand? 8,600,000. Okay. What else I need to discuss for you? Let me see. So this is the steps, as I said. Update depreciation expense and accumulated depreciation, and then record. Oh, disposal. If the asset is sold, so this is the last item in the tangible assets area. If the asset is sold, the asset is used up for a while and then it is sold or disposed of. What happened is, now disposition may take many different forms. Okay? Sometimes the asset is sold, sometimes the asset is donated, sometimes the asset is taken over by the government and government provides the compensation. Sometimes the asset is destroyed in the fire or flood or natural calamity and the company recovers the insurance. Okay? So in all cases, when the asset is disposed of, then there is certain amount of cash flows to the company in the form of sales price or insurance premium or government compensation, things like that. But the overall accounting process is the same. What you do, when the asset is disposed of, just like impairment loss, you have to update the accumulated depreciation first at the point of disposition. Okay? So you update the book value of the asset. And then you compare it with the proceeds that the company is going to receive, and from the difference you record gain or loss. Okay? This is pretty standard, regardless of what kind of disposition form is taking place for that asset. Okay? So here is one example. At the end of 6 years, Cedar Fair sold one of its junior roller coaster for $5,000, $50,000 cash. Many roller coaster, this is a junior roller coaster. They sold it for $50,000 cash. Original cost was $100,000 and was depreciated using straight line method over 10 years. 10 years, right? So at the end of year 6, that means how many years depreciation has already been charged? 6 years, right? And $100,000 is the original cost, so residual value is considered as 0. So over 10 years, $10,000 each year, right? For 6 years is $60,000, right? So that's the accumulated depreciation. You subtract from $100,000, the book value of that roller coaster was $40,000. It was sold for $50,000. You have a gain of $10,000, right? That's not the gain on disposition of asset or gain on sale of asset. That gain is recorded in the income statement. So this is what we see here, right? So we have to update the book value and then consider that updated book value against the sale proceeds. That's a really straightforward thing. Keep in mind. Always remember, whatever happens to an asset, always you have to figure out at the point of incidence, what is the updated book value of the asset? That is, what is the updated accumulated depreciation? Okay, that's the basic principle. Okay, that's the basic principle. All right. Okay. Now, quickly, I want to talk about the intangible asset. Now, here is the thing. Now, when we talk about total asset, long-term asset, right? I will send you, upload an annual report, and I will particularly ask you to focus on some of the pages. Okay, I will identify those pages, and I hope that you and your friends, what I've sent today, will take a look at those things. Okay, all right. Now, so when we talk about I uploaded one announcement this morning, right? Have you seen that in Brightspace? So we have a back-to-back one quiz in the next Monday, and then no, not next Monday, after next Monday, because next week you will not have any class. So you don't have to go through this kind of pain sitting in the class, right? So we will be inside. We enjoy life. Okay,
So there's also pain outside.
It's not a reading period, it's an enjoyment period. Right? So that's the next week. Week after next, on Monday you will have a quiz, and then I will tell you what will be the contents of that quiz in the next class, Wednesday. And then we have a midterm exam on Wednesday. Okay? So you are, all of you are aware of this. Now here's the thing, what I was saying, property, plant and equipment, P, E and E. That we have so far discussed, right? So the tangible asset. Now after that there is one category of balance sheet, which is intangible asset, right? So that's what we are talking about right now. Now this intangible asset may take many different forms, right? So we are talking about intangible asset. Intangible means you cannot feel it, touch it, see it, no. It's a right conferred on or acquired by a company, and that right helps them generate additional economic benefits in terms of earnings and cash flow. So trademark is one, right? It's a special name, image, or slogan. Copyright, you know that. All these terms are known to you. It's not that you don't know, you know, right? Copyright, patent, right? It's an exclusive right. Patent's life is actually 20 years. That's the legal life, right? technology as into software, web development, work, franchise, license, right? Franchise is a type of license, you know. The company acquires that right to use certain products or services. As I said, Tim Horton is a perfect example of a franchise. Then goodwill. Goodwill actually results when a company acquires another company and paying more than the fair value of net assets of the company which is going to be acquired. So the acquiring firm is paying more. Why? Because there are certain intangible attributes which cannot be particularly linked with any kind of asset. For example, a strategic location of the company which is going to be acquired, a specific type of technology, a particular management skill, a unique CEO attributes. You know, sometimes the CEO's value increases the value of the firm, right? Sometimes you will see in the newspaper that a well-known CEO resigns from the company and then the market value of the stock took a big hit because that guy is going to go out, right? So this kind of things, specific management attributes. So for all these, it's called unidentified intangibles. Okay? Say the net fair value of or the fair value of net asset. Net asset means the total asset minus liability. That's the net asset. That's taken over by one company. Say $150,000, but the company is paying $180,000. Why the company is paying more than what the net assets that are being taken over? Because of that unidentified attributes that they calculated. That, well, we should pay a little more than that, it should be about $30,000. So that's called goodwill. Okay? That's called goodwill. Anyway, so when the company, here there's a little bit distinction between how to record the value of intangible assets. There's a little bit distinction here. Number one is when the asset is acquired, the accounting is the same, that you account for the cost of acquiring the asset and any other costs such as legal fees or any other documentation charges or things like that. These are all put together and recorded in that particular asset account when the assets are purchased or acquired. However, some of the assets are internally developed. For example, patent. The company develops some particular technology and apply for the patent, and they obtain the patent. Now the cost, say, they spend millions of dollars to develop the technology, which will be charged as a part of R&D, research and development cost. Okay, and that is a regular business expense. However, if the company paid for legal fees, only that portion of fee will be recorded in the patent account. Okay, so that's a kind of distinction that needs to be made when we talk about intangible asset. Now, once the asset is recorded, then over the life, useful life, again, here is a kind of estimation. What's the useful life of an asset? Sometimes what happens is the legal life is much longer than useful life. Okay? For example, a company acquires a patent and the patent's legal life is 20 years, but the company estimates that its useful life will be 10 years or 12 years. So in that case, the company will consider 10 or 12 years as the estimated useful life for the purpose of calculating the amortization. I already said that when we account for the cost of using an intangible asset, we use the term amortization, not depreciation. That's the convention. Okay? Amortization. So we do that. So legal life or useful life, whichever is shorter. That's the principle. Okay? Either legal life or useful life, whichever is shorter. So in this case, we don't consider 20 years, we consider 12 years or 10 years. That's the useful life. Okay? And then comes goodwill. Now, intangible assets are of two types. Some intangible assets have an unlimited life. Unlimited life. For example, brand name, trademarks, logo, right? These are deemed to have indefinite life. When they have indefinite life, then there is no amortization. Because it has indefinite life, right? It will continue on and on and on. The company will pay a nominal fee to extend or to continue to possess it, extend its availability to the company. But the company will periodically test those assets for impairment, whether those assets have impaired in regular impairment test is necessary. And the other part is the limited life intangibles. So, for example, patent or franchise. Some franchises have both limited and indefinite life depending on the contract. I can tell you some local radio station or television station, they telecast, say NBC, ABC or CBS, that's the national television, right? So, in US, right? So NBC purchased the broadcast license from a local radio station in Detroit, for example. And with a nominal fee, they extend their usage. So that's a kind of unlimited life broadcast license. However, there are certain type of license the company is using, and its life is only 5 years, and at the end of 5 years, the company will have to go through a competitive bidding process to reacquire and renew the license. And in that case, we will say that this license is deemed to have limited life because at the end of 5 years, there is no guarantee that the company will be able to renew it because the company will have to go through a competitive bidding process, right? So that's the kind of things. So when there is a limited life, then the process is the same. You take the original cost, the recorded cost in the asset, and then divide by number of years of estimated life. Now, we don't consider residual value because it's of no use estimating residual value because at the end of the useful life, in most cases, almost all cases, 99% cases, the intangible assets that don't have any value because its life is over, right? So it's of no use using estimate any residual value. So residual values are not estimated. Okay? All right. So, and then again, just like long life tangible asset, disposal of intangible asset results in gain or loss. Again, we have to figure out what is the after all this accumulated amortization. So either we write amortization expense credit accumulated amortization or amortization expense credit asset account straight away. Both processes are prevalent. So in most cases, what we do is we don't operate accumulated amortization for intangible asset. We just simply debit amortization expense credit asset account straight. Okay, reduce the value of the asset. So this is one thing. Stater Fair purchased a patent for a water coaster for $800,000 and intends to use it for 20 years. So what is the amortization each year, right? So $40,000. That's the rate. Very simple. Okay, you understand? I don't want to extend much because I want to restrict my lecture to the materials because we have a lot of things we have to cover in managerial accounting. We'll find it more interesting there. Okay, more interesting stuff in cost accounting area. And finally, when we talk about receivables, we have seen some ratios. In chapter 4, we saw some ratios. Here also there are some ratios for the fixed assets turnover. Fixed assets turnover actually indicates the efficiency in utilizing the asset to generate sales. Okay. So if here you see net sales revenue over average net fixed assets. Okay. So in your book, it says turnover analysis, Stater Fair 0.85, 6 Flags 1.17, Facebook 2.91. You can compare Stater Fair with 6 Flags. Both are amusement park. Stater Fair 6 Flags. But you can't compare their fixed asset turnover ratio with that of Facebook. Facebook is a different industry, right? It's a technology. Right? So you can compare apple with orange. So that's the kind of case you have to think about this thing. have to compare the fixed assets turnover over time, right? So things like that for an individual company, and that with its close competitor, things like that. Okay. So review that. Review demonstration case. Demonstration case is pretty diversified industries on page 437. I want you to review it. It's very good. This demonstration case is really very good. Chapter summary, you can do that. I will go over some exercises in the next class because I want to talk about the quiz a little bit, right? Today, and then next time I will suggest. Okay, let's do a couple here. Exercise 9.2. Look at page 447. Exercise 9.2. Okay, 9.2. All right. Are you there? Exercise 9.2. Why are you looking at your cell phone? I don't understand.
Exercise
You don't listen to
9.2.
me. I mean, what language I will have to make you understand? Tell me. I don't know barely English. You need to understand. Don't look at your cell phone. I particularly forbid all of you. Don't do that. Okay. So let's talk about this.
Kennedy.
Brigadoon Consulting bought a building and the land on which it is located for $182,000 cash, right? Land is estimated to represent 70% of the purchase price. The company paid $22,000 for building renovations before it was ready for use, right? So sometimes what happens is the company purchases 2 or 3 assets in one single transaction, okay? One single thing. Now the question would be how to allocate the purchase price across those assets. Those assets are disparate. Disparate means different, right? Land building. Normally what we do is we consider the standalone fair value of each asset, okay? And based on the proportion of the standalone fair value, we allocate the total lump sum amount to those assets. Okay? So here is the thing.
464.
It says that they paid $182,000 and land is estimated to represent 70% of the purchase price based on that fair value. So they didn't give you the fair value. So 70% of 182,000 will be allocated to land and 30% will be allocated to building plus 22,000 for building renovations before it was ready for use. So another $22,000 will be recorded in the building account along with 30% of $182,000, right? Because that's a capital expenditure required to make the asset ready for its use. And then it says that, so explain how the renovation cost should be accounted for. As I mentioned, you should say this and then give the journal entry. So you have to make the journal entry, right? So let's see, where is it? Here, 9.2. So you have to make this one, right? So journal entry, and then you can post that. Okay, so this is the number, right? And then it says, compute statement depreciation on the building at the end of the 1 year, assuming an estimated 12-year useful life and 4,600 estimated residual value. So what's the total building account balance? So the 76,600, right? So you subtract from there $4,600, and then that's your depreciable value is $72,000, which will be depreciated over 12 years. So each year is a $6,000 depreciation, right? Very straightforward calculation. So you have a $6,000 depreciation, and it says then what should be the book value of the land and building at the end of year 2. At the end of year 2, year 1 6,000, year 2 6,000. It's a straight line depreciation, right? Total $12,000 accumulated depreciation on building. Land doesn't depreciate, it's not subject to depreciation. So the land value will remain unchanged, 127,400, right? So as you see here, and building 2-year depreciation will have this. So here is the, so it's, as I said, it's all about calculation, right? Let's talk about 9.3 a little bit. Determining financial effects of an asset acquisition and straight-line depreciation. Conover Corporation ordered a machine on January 1st at a purchase price of $20,000. On delivery, January 2nd, the company paid $8,000 on the machine and signed a note payable for the balance, right? So it's a partly by cash, partly by credit transaction. So they acquired $20,000, they paid $8,000 cash, and they signed a promissory note. It's a notes payable, $22,000. On January 3rd, it paid another $250 for freight on the machine. So that also will be recorded in the asset account, $250 for freight. And then on January 5, Conover paid installation costs relating to the machine amounting to $1,500. So another $1,500 will be added to the asset account, right? So installation costs, then freight charges, everything will be accumulated in the machine account. And on December 31st, at the end of the accounting period, Conover recorded depreciation on the machine using straight-line method with an estimated useful life of 10 years and an estimated residual value of $2,750. So first of all, we have to figure out what would be the value of the original cost, right? What would be the original cost? So we have $30,000 plus 250 plus 1,500, right? So this is the original cost. Okay, so indicate the effects in the basic accounting equation. So you can do that, you know this stuff, right? So as you see, January 1st, no effect because they entered into a contract. There is no event here. January 2nd, there is an event, right? So as you see, $30,000 equipment, cash goes out and notes payable. Then they paid for freight charges, they paid for installation. So this is the total cost, right? 31,750, right? That's the total cost. And then the question would be, compute the depreciation expense to be reported for the first year. First year, so we have an estimated residual value 2,750. You subtract from 31,750. So 29,000 is the depreciable value, and will be depreciated in 10 years, right? 29,000 divided by 10. So this is your annual depreciation for each year. So at the first year, this is the depreciation, and it says what should be the book value of the machine at the end of the second year. So 2-year depreciation, 29,050. So 31,750 minus 58. So that's the book value. Right? So that's the way, step by step, you have to calculate this. So anyway, look at exercise 2, 3, 9, 4, 9, 6, 9, 10, 9, 11, 12, 13, and M 9, 7, 8, 9, 11, and 13. Will I write it down, but I will also post in the blank space. Any question? I will finish this part in the next class, and I will talk about liability. Probably I'll be able to finish it up on that chapter also a little bit. It's not a very difficult chapter. I'll finish it up by June 26 after your quiz. Quiz will be on 8, 9, and a part of 10. Let me see how far I can go in the next class. And then midterm, you know the coverage. Okay? All right. Any question? No? Okay. Now let me talk about the quiz. Right? is your quiz, right? Alright? This is your quiz. What's your name? Who else didn't get? Look at this board and tell me if you have any question. The board is the right answer, right? Board.
No,
But you can sign. Sign. Sit down. Any question? No. I assume that you are okay with the first four, right? The second one. Any question? Look at this. Up to number 8. Any question? Up to number 8.
Number 8? You could please explain more about
5,
number
6,
8.
7, 8.
Number 8.
Number 8, okay. How would cash collected on accounts receivable affect the balance sheet? How? Tell me, you tell me. Paynham, right?
Payment.
Payman, you tell me. You have to tell me, I will not tell you.
Okay.
How, so cash,
Cash increase assets.
yes, increase asset and decrease asset. So increase one form of asset and other form of asset is decrease. You debit cash, you credit accounts receivable, right?
Yeah.
You understand?
So it would be C.
Yes. So this is the offsetting entry on the left hand side of the equation. Okay? So the equation is in order. Any other question? Okay. Number 9. Number 9? No? Okay. So let's go to 10 to 14. Look at the 10 to 14. I'm ready to explain.
Yes.
I can explain like, he asked me. Okay, so you have no question. Alright, next is 15. 15, no question. If a company fails to adjust the accrued revenues Accrued revenue means accounts receivable debit, revenue credit. If they fail to record that, then what is going to happen? Assets will be understated and revenue will be understated. Right? Okay. 16. Do you have any question on 16? It's a calculation, interest accrual, right? Interest accrual. So October 1st, 2022 through December 31st, 2022, the accrued interest must be recorded. 3 months accrued interest, 6% on $30,000, 1,800 a year. So for 3 months, 1/4, right? $450. So interest expense debit, interest payable credit, 450, 400, right? You have to account for that expense. Okay? Alright, then 17 to 21. 17 to 21.
17 and 16.
B.
18, you want to know 18? Okay. The company has an asset account. Prepaid utilities, right? The utilities paid in advance. With a balance of $3,750 at the beginning of the month, the company used $980 of utilities during the month, sorry. Which of the following statement is true, right? So utility used up. That means what do you do? You debit utility expense, you credit prepaid utilities. Okay? So you debit expense. This is a kind of deferral. Deferral. So one asset is linked with an expense account. One asset account is linked with an expense account. Think about deferral. You paid utilities in advance. You paid insurance in advance. So when time passes, when utilization takes place, then you have to increase your expense account, you record the expense account, you reduce prepaid utilities, right? So that's the way it goes. So here what happens? Your expense account, you record this $980. As a result, your retained earnings and stockholders' equity should decrease, right? Retained earnings will decrease. Why? Because that expense will go to the income statement, it will reduce the income, and the reduced income will be reflected in stockholders' equity. So that is the connection. Okay, that's the connection. What else?
B.
What else?
What about 17?
17. The Gulf convenience store. These two guys are asking me question. How about the rest? You are feeling all right? Nobody except them. Okay? So Gulf convenience store chain buys new soda nation for $450,000 and pays $50,000 for installation, right? So what is the total cost? $500,000. One half of the total cost is paid in cash, right? So they paid $250,000 in cash. And how should the company record this transaction? They debit equipment account $500,000. They credit cash $250,000. And then they credit and notes payable, right? Remaining part is credit.
And why it shouldn't be D? What about we don't have to pay 50,000 in expenses? It's not utility, it's expenses.
No. You are talking about 17?
17, yes.
Yeah. They debit $500,000. You credit cash and notes payable. That's it. Part by cash, part by credit. That's the appropriate number.
So the installation cost tax.
What's that? Yeah, 50 installation. That's it. Recorded in that. It's total. No, installation for the purpose of equipment. Yeah. Today, what did I discuss? An asset, the installation cost, insurance cost, any other rate charges. Okay, don't worry about it. You understood? You understood? That's the important thing. You understood. Any other?
excuse me, I have some problem with Act 17.
Yeah.
When we buy some machine, it would be as an asset. But we pay 50,000 for an installation, it should be an expense, it doesn't.
Installation is a part of the asset cost in order to make the asset ready. Installation charges are always a part of the asset cost. When you purchase an equipment, there are several other costs. These are called the supporting costs to make the asset ready for its use. For example, if you buy an asset and bring the asset to your warehouse by paying transportation cost, that transportation cost is also a part of asset cost.
So it shouldn't be an expense, it's an asset.
Yeah, this is an asset, it is a capitalization of the cost, not a part of ordinary business expense. Okay?
Okay, so when we gonna sell that asset,
Yeah.
it will be reflected on that.
If you sell the asset, then you have to see what is the book value of the asset, right? So, and then you compare that with the sale proceeds, as I just discussed today, right? And then you record gain or loss. Okay? So installation cost, any other insurance charges at the time of asset acquisition, any other transportation cost, everything will be combined in the asset acquisition. Okay?
So they are not.
Similarly, if you spend any cost on renovating the asset or at the time when you acquired the asset, for example, a building, and just we discussed one of the exercises, that renovation cost is also a part of building cost. Because you are making that expenses to make the asset appropriate for its use.
But these are not expensive.
Say again?
They are not expensive, they are assets.
This is the capitalization of the cost. Simply think about this dichotomy, one this way, one that way. That whatever cost is incurred to make the asset ready for its use in the regular operations of the business, all these costs are to be capitalized or recorded in asset. Okay? Any other question here? Go ahead.
22.
20. The first bank motorcycle company, hold on, don't talk, please. Who is talking? The first bank is when they are earned and not necessarily when cash is received. Regardless of cash receipt and payment, revenue earned must be recorded, expenses incurred must be recorded, right? That's the revenue recognition and expense recognition principle. That's the founding principle of accrual basis accounting. That's why we are doing this, and these are permitted under the generally accepted accounting principles. Okay, 28. No. Last two questions, 29 and 30. Last two questions, 29 and 30. Okay? What do you think? It's okay? Keep your that skinny stanchion inside the booklet and bring it to me.